by the end of the summer. Here to break it all down, the economic implications of this, we want to bring in Thomas Simmons, Jefferies U.S. economist. Thomas, it's good to see you here. I know that you've been digging into exactly what this will mean for Americans, but when it comes to the economy, what could this potentially do to consumer spending?
Yeah, I think that it's a really interesting topic because it's something that's very, very difficult to quantify. You know, when we stopped the student loan payments back in 2020, it came alongside all these other stimulus packages that we're going through at the same time, right? Direct stimulus checks, bigger unemployment benefits, rent moratorium, all sorts of different things. So it was really hard to isolate exactly how much of a stimulus we got just from stopping those payments, which we have seen a number of different sort of estimates on you know, how much student loan borrowers pay per month, but it looks like it's somewhere around $400 a month on average. So now that we've seen all these other stimulus programs and packages expire and sort of, you know, rebound back to, you know, we've gotten the payback on that. We haven't seen it yet with student loans. Like you said, we're very likely to see that as soon as, you know, we get into August and September at this point. And, you know, it looks very similar to what we saw in 2013 with the fiscal cliff. Back then, there were some temporary tax breaks that were all kind of expiring at the same time. And if they all expired at the same time without any sort of offsets, it would have been a very significant fiscal drag. The deal that came together essentially amounted to a 1% increase in payroll taxes for, you know, people who receive a paycheck from their employer. That ended up generating a drag of about 1%, a little bit more on discretionary spending to overall PCE. So, you know, when you look at economic growth in the first half of 2013, there's a very noticeable dip in PCE and thus dip in GDP as well.
And speaking of that, Thomas, Diane here, what are you expecting as for the broader impact to the economy from? So obviously this could clearly have an impact on consumer spending, but what's the overarching ripple effect that you expect to see from these student loan payments coming back into people's household budgets?
Yeah, I mean, there's you know, obviously the direct sort of headline impact in terms of having less to spend elsewhere. But the other issue is, you know, not just spending on goods and services, but also servicing debt as well, too, right? Mm-hmm. We saw delinquency rates on credit card loans and mortgages, auto loans, you know, any sort of consumer loan fall to very, very low levels during the, you know, the immediate sort of aftermath of the pandemic. And that's as student loan delinquencies essentially fell to zero. You know, it's hard to be delinquent on a payment that isn't necessarily required of you at that point, right? So as we're now adding this back in to balance sheets that are already pretty strained by 2 years of very high inflation that's run significantly higher than wage growth, the capacity to absorb this in a lot of budgets, I think, is much worse now than even, you know, again, I'm talking about our 2013 example. You know, economic growth was relatively slow back then, but interest rates were really low. Inflation was really low. The labor market was still in the process of recovering. There were a number of sort of offsets, I think, that you could say, all right, well, you know, households will be able to absorb this eventually, and that, you know, we won't see growth, you know, impaired for a long, long time. But here I'm much more concerned that because, you know, consumers have taken down essentially all of their excess savings from the, you know, period of time during the pandemic when they couldn't be spending money, you know, during the lockdowns and that sort of thing. As they've, again, had to use those savings to offset the impact of inflation, I think now it's just the worst possible time for many of those households to be hit with this extra bill.
Yeah, it certainly is a very terrible time. Millions of Americans can't afford it right now. Thomas, what does this mean just in terms of the odds of a recession? We know the consumer has been one of the bright spots of the economy, has been extremely resilient, like you have been saying, really throughout the pandemic. Does this then increase the odds that we'll see a recession?
I think it does. You know, I've been expecting that we're going to get a recession towards the second half of this year for a long time now. And the student loan issue just kind of compounds issues that I think are already sort of set in place in not only in the consumer spending mix, but also in the labor market, which is eventually, of course, going to lead to further issues with consumer spending down the road. I think that businesses have done really well in passing along increased costs to consumers so far. It has really, you know, been remarkable. I had expected there would be much more margin compression this year, and instead they've actually done a pretty good job of recapturing a lot of that margin. I don't think that happens on an ongoing basis, you know, into infinity, because again, I think that a lot of those cost increases have been absorbed by this savings that has a finite amount. There just really isn't that much more to go. So if we do see the next phase of margin recapture and growth for top line, or actually I guess bottom line for corporations, I think layoffs are really the next piece of the puzzle, because it's basically the only way that they're going to be able to find cost savings significant enough to continue to deliver for investors. But as that happens and we see wage growth slow, it's going to really impact consumer spending as well. Sorry.
So, Thomas, I got to ask, though, the job market has shown itself to be surprisingly resilient. We had the last jobs report was better than expected. Once again, we have another one coming this Friday. We had JOLTS out today that was, was that more than 10 million. That was more than expected. So are we really expecting the jobs report showing anything but more gains? Like, when are you expecting those layoffs to show up in the monthly numbers?
Yeah, so I can't sit here and tell you that I think we're going to get a poor number on Friday. I actually think we're going to get something, around 230K for payrolls and basically an unchanged unemployment rate. But these are all more or less, I think, lagged indicators telling us sort of where the labor market already was for the last few months. The primary job growth engine so far during this expansion has been in small businesses. And you referenced the JOLTS data. We saw this huge increase in businesses with only 1 to 9 employees, producing many of the job openings and thus many of the jobs. Now, those are brand new businesses that have just been started. We've seen an explosion of those businesses being started throughout the last 3 years. I really suspect that given that their primary source of credit is through bank lending, that there's not going to be this further and further legs of that same sort of development of small businesses. I don't think that this is something where you can say, oh, well, we had all these issues in the regional bank system that have now kind of impaired this flow of credit and we're going to get all these negative consequences. These were already sort of things that were set in motion by all of the cumulative rate increases that we've had so far through this cycle as well. Credit tightening has happened on the lending side, and also demand has fallen off sharply as well. And I think that as we see that demand translate to fewer small business creations, it's going to lead to less hiring, and thus as we see less sort of gross hiring in the labor market, we'll start to see weaker businesses fall off and have to cut headcount, unfortunately.
All right, Thomas Simon, something we, of course, will continue to closely watch. Thanks so much for joining us here, Jefferies U.S. economist.